Welcome back, everybody, to the 36th episode of the Wilton Report, the only podcast, videocast dedicated to all things Princeton real estate. Today, we have a special format. I have a guest on, Adrian Colarusso from Target Rock Wealth Management, and it's going to be a great episode, so stay tuned. In order to be compliant, we just have to let you know that the views Adrian expresses in this podcast are his own and don't necessarily reflect the views of his firm, Target Rock Wealth Management. The information he shares is for informational purposes only and should not be construed as financial advice. That being said, strap in, it's going to be a great episode. Okay, good morning and welcome back to the Wilton Report. This is our 36th episode, and it's pretty exciting because it's our first episode where we have a guest. A friend of mine and a customer and a Princeton resident, Adrian Colarusso, is here this morning, and we are going to talk, of course, all things Princeton real estate. And Adrian is going to present some interesting financial models for people who are thinking of becoming landlords and/or are current landlords and are thinking about the best use of their money. So that's going to be today's episode. So, Adrian, welcome.
Awesome. Thank you so much for having me on, Josh.
Thank you for being the first guest.
I'm happy to.
I know we've been planning this for a while.
Yep.
All right. So pretty exciting. So why don't we start with you and your background? These guys are used to me talking. So kind of tell us your story and how you ended up on the Wilton Report.
Yeah, sure. So one of my catchphrases is Princeton born, raised, educated, and employed. It's a little bit of a technicality. I wasn't really born in Princeton. I just kind of feel like I have. My kids are now kind of born in Princeton. So if you consider both generations, you know, the Colarussos are born, raised, educated, and employed. But, you know, grew up in New Jersey my whole life, went to Princeton, graduated and stayed here. And, you know, I spent 10 years at BlackRock in Princeton right here. I had this idea coming out of Princeton with an economics major. You know, I wanted to work in finance, but I wanted to have a successful career in that industry without ever having to go to Manhattan. And so far, so good.
So far, so good.
Not that I never go to Manhattan. I still go. I just mean I'm not going to do the daily schlep.
You're not taking the 514A?
I'm not. Absolutely not. I'll do it occasionally. And my wife, God bless her, she does it, you know, a couple times a week in her capacity as still at BlackRock. But you know, we are Princeton people.
So what's the name of your new firm?
So Target Rock Wealth Management. It was founded by my partner, Matt McKee, who also just moved down from Manhattan to the Princeton area. So we have a draw here. The world comes to us here in Princeton.
Good. We like that.
Yeah, exactly. So super exciting development. We're about, almost 2 years into our partnership in the wealth management business together. He founded the firm. I actually met him down here at Springdale where I'm a member playing golf. His father-in-law is a member there. So I randomly got paired up with him one day and we hit it off. And, you know, this was about the time I was kind of halfway out the door at BlackRock thinking about my next career move. And he had just founded the firm. And, you know, we started talking about what he was doing exactly. And, you know, I started kicking the tires with him a little bit. And I really thought he was a great guy and doing things the way I would do them myself. So when I left BlackRock, it was, you know, kind of rather than reinvent the wheel, it was, you know, seemed a lot more efficient and perhaps more fun to do this business with somebody who's already kind of broken that ground, so to speak. So now we're kind of building it together, and you know, now that we're kind of circumscribing ourselves around Princeton a little bit more with him coming down here. You know, we want to grow with more Princeton families than we already have. So in any case, though, we want to kind of talk about, I think today, the intersection between your business and my business.
Yeah. It's going to be an interesting conversation.
Yeah.
So if you're a landlord, I would say, put your seatbelt on.
Sure.
So why don't we talk about first things first, right? The best use of money. And I think that's really the concept of what we're talking about today. So, you know, the conversation today is going to be geared towards probably existing landlords, but I think it's going to be geared towards people who are aspiring landlords, right?
Or even aspiring homeowners, right?
Aspiring homeowner too, right?
Anyone who wants to own real estate as part of their wealth picture.
Correct. And it's part of an overall asset class, right?
Mm-hmm.
So let's talk about the rate of return on Princeton rental properties for landlords. We just did some research this morning, and I think I was a little shocked in terms of that math. So why don't you kind of explain what we saw?
Yeah. So, I mean, long story short, the return potential is quite low, which I'm sure a lot of your listeners, I know there's a lot of people out there enamored with real estate as an asset class, as an investment. I think, I come across this a lot in, talking to dozens and dozens of people about, their wealth and how they think about it and what they want to do with it and where they think their money is placed most safely. And real estate is kind of at the top of the list for a lot of people at like, you can't go wrong investing in real estate. And I think the overall message today is not to say that, I don't want to look, real estate, I like to say stirs the soul for me too. I love real estate. I'm probably over allocated to real estate myself. But I just want to have a different perspective for people about alternative uses of their money and thinking about their overall asset allocation, their overall wealth allocation. You don't want all your eggs in one basket. You want to be diversified. And when you're thinking about how much do I put in this basket or this basket or this basket, one of the things you want to look at is the return potential, right? And higher return potential assets should probably get a little bit more of your money, all else equal, than lower potential return assets. And I think, what matters for your future returns is the price that you buy it at. And as we know, across the country, and in Princeton in particular, real estate prices have risen very rapidly since COVID. We're talking about 30%, call it, across broad real estate markets. And obviously, you can slice and dice those markets in a lot of different ways, even within a local market like Princeton, commercial, residential, so on and so forth. So the math, Josh, I mean, you kind of had the data. So like, why don't you kind of explain what we just did this morning? We took a couple of data points. This is not a study, right?
It was interesting because the data was consistent. So we looked at 3 different rental prices. We looked at one at $1,850, which is a studio in Palmer Square, which I would say the retail price, if you sold it today, is about $350, right? And then we looked at a duplex, which is a very common real estate product in Princeton, not a lot of other towns, but Princeton has a lot of duplexes. So again, the rental price on that was about $4,500. You would be selling that for about $799, give or take. And then we looked at a house that was renting for $6,300, and the retail price of that would be $1,300,000, $1,350,000 today, over half an acre in Little Brook. So there's building potential there. And the consistent rate of return, right,
was in the mid threes,
3.1%,
3.1% to 3.6%. And
the studio was 3.1.
Right. So, I mean, and this is speaking to cap rate.
Cap rate.
So if you're a real estate investor, you're probably familiar with the concept of cap rate. And
so why don't we do this? Why don't we explain what cap rate is in layman's terms?
Sure. And it's very simple. It's just, how much money are you going to make on the top divided by what's the asset price on the bottom, right? Or in other words, how much money would you have to put in to buy that asset, right? So it's your yield on investment, right? Now, importantly, this cap rate does not consider the appreciation or depreciation of the asset in question. But when we were looking at these listings for rent, these recently listed rentings, and just anecdotally, I know I have a friend who's a renter. I have a friend who's owning and renting out their place. I have a neighbor who's renting one of these riverside houses from somebody who's a quote unquote investor, and I question the attractiveness of that investment for that person. But the point is, you take your gross rental income, so that monthly rental rate, divided times 12. Now subtract out taxes, which are quite high in Princeton.
Right. So for the duplex, we figured it was about,
I think it was about 10,000 in taxes.
12,000.
So I would think it was 4,200. So we're talking $50,000 or so in rental income to that property owner, minus the 10,000 in taxes, minus an HOA fee, which was relevant in the studio case, minus we figured capital expenditures, heater breaks, happened in my rental unit last year. About 1% of the value of the property per year is a rule of thumb for how much you should budget for those things. So when you subtract all that out from the gross rental amount, and we haven't even talked about, real estate commissions to get it rented or any other kind of issues that might come up, tenant delinquencies, right? There's a lot of risk there. You subtract all that out and then divide it by the market value of that price, you're getting a number like 3.1 to 3.6%.
So let's compare that to, be really boring, a savings account.
High yield savings account. A lot of my clients are stashing a lot of money away in high yield savings account. 4.5%, 5% yields. Maybe that's in a CD. Maybe that's in a short-term treasury bond. Basically very safe assets that are yielding significantly higher, meaningfully more than, if you were to buy a real estate property. And then that's not even to mention the sweat equity that you have to put in as an owner. I mean, you could also hire a property management company, but maybe more people should do that, right? Because they don't value their own time.
I highly encourage that, considering I own one. So yes, I highly encourage you.
Absolutely. I know.
Us in particular.
One of the friends who's renting in Princeton, the landlord comes and mows the lawn for that family. And, that's time, right? You got to spend time on your properties, managing them, even if you do have a management company, honestly. So your sweat equity is worth something too. So subtract that out of the numerator as well on your return. Whereas a savings account, you have to do nothing. Now, granted, also, again, you're not including price appreciation in there, but again, I would say that a lot of that price appreciation has happened. It's been front loaded, right? With what's gone on since COVID. So going forward, is there going to be a reversion to the mean in prices? I don't know. I'm not calling for that. No one can predict that.
That's a tough question. Right now, I'll answer it based on current inventory levels. No.
Right. Supply is very
unfortunately, and I do mean unfortunately, because there was a house on Rosedale Road last week, and our buyer won the bidding, 12 offers.
Yeah.
12 offers, over $1 million, and it needed work, So, and I say that unfortunately because a lot of people are it's soul crushing on the consumer side. Yes. Good for the seller, right? But on the buying side is a little bit tough.
Yeah, I think that again, part of the message is here is that this is a historic. I hear you say this a lot, and a lot of the stuff that you put out, Josh, is it's a historically tight market. There's an historic sellers market, and I think that if we can get through to some people, it's like, am I really holding this property for the right reason? Should I put it out into the market and let, because Princeton as a market is screaming to be owner occupied. It's not screaming to be investor owned and, rented out.
Based on a 3.5%
exactly
return.
Yeah. I'm not as familiar with other markets out there. But if you want real estate in your portfolio, there's a lot of other ways to do that where you probably have a higher potential return.
So let's say, there's a fair number of investor landlords that listen to this podcast, believe it or not. And they're just like, you know what? Okay, we'll give Adrian the benefit of the doubt. What would I do with so now I'm going to sell $1 million asset, which I bought for $200,000, right? So now you have an $800,000, right? And I'm going to lose the depreciation of my taxes.
Mm-hmm. You're going to depreciation recapture, right?
Maybe I have, a home equity line that I kind of, keep open. Maybe I don't right now based on interest rates, but, I use that for cash flow when I need it. What's a good alternative to that duplex that's now worth $800,000-900,000 that I bought for $200,000? I sit down with you, you say, do what?
Well, I think it totally depends on your personal situation, right? And when, for example, we have clients come to us with their current wealth picture, we're looking for concentrations in risk, right? Where can we kind of get you more diversified? But importantly, the biggest impediment to doing that in most cases is taxes. So in this hypothetical scenario you're talking about here, you're talking about a massive capital gain. If you haven't lived in the house for 2 out of the last 5 years, you don't get that $500,000 exclusion for a married couple or $250,000 for an individual on your capital gain. So, what are your options? I mean, you could just sell and pay your capital gains and then kind of diversify into other assets like stocks and bonds. Think, we were talking about treasury yields being more attractive or higher than Princeton real estate yields right now. But again, totally different asset with totally different risk and return profile. But it all depends on what does the overall pie look like? How are you splitting up the pie? If Princeton real estate is 90% of your net worth, then, perhaps that's a chance to diversify into other assets that are going to give you a higher rate of return. And in 30 years, I would say that the person who invests more broadly in stocks and bonds and perhaps other forms of real estate, will be wealthier, and perhaps significantly more so at the end of that time horizon. Another option you can consider is 1031 exchange, right? Tax-free exchange into any number of other, it's very broad how you can tax-free exchange.
So usually when I bring up a 1031 exchange, right? And by the way, for anybody who does listen to the podcast, we do have 2 seminars coming up on December 7th and December 9th. December 7th at 6:30, December 9th, I think, is at 10:15. We'll do more announcements on it. But when I say 1031 exchange, usually what happens is even a professional landlord, their eyes glaze over, right? They kind of know the concept of it, but they don't live it day to day. Why don't you take a minute and explain what a 1031 exchange is? Because I know you like this concept.
Yeah.
Right. So
yeah, I mean, it's a way, if you have a capital gain, you bought something 20 years ago and it was 200,000 and now it's worth $1 million. You have an $800,000 gain where when you realize that gain or when you sell the asset, the IRS is going to, you have capital gains tax, right? And it could be 15%, 20% of that gain for the federal level, maybe 23.8, depending on what other income you have. And then New Jersey taxes capital gains at the state income tax level. So I think it's, 10%. It could be 10% in a higher bracket. So, that 800,000, you're talking about potentially, 33% of that gain is going to get taxed. So instead of selling the property, just outright and taking the cash, you can reinvest the proceeds of that gain into another property. And there's procedures, legal procedures for how you designate this, and you got to designate.
We'll be going into that.
Yeah, I'm sure with your seminar. I'm not going to even try to go there. Right.
It's a lot.
Yeah.
Right?
It's funny. My first experience with 1031 exchange was just watching my dad do it. He grew up in real estate. So I watched him, kind of make and lose a lot of money over the years in real estate, in Princeton and elsewhere. But he worked for a guy who owned a lot of raw land that was not generating any income. It was generating some hunting lease income. And, there was a big tax liability. This land was owned for decades. And, the owner of the land was not aware of the 1031 exchange until my dad came along and said, you know what, your real estate portfolio should probably be turning over into more cash flowing assets. So my dad was instrumental in kind of using 1031 exchange to turn over this very, very low yielding, but highly appreciated and valuable real estate assets into cash flowing real estate assets like buildings on Nassau, commercial buildings on Nassau Street, for example, among others. Sold land to a golf course, and there's a bunch of different things that my dad did in his real estate career. But yeah, so that's it still keeps you concentrated in real estate, obviously. But at least it's a way for you to maneuver.
So diversified revenue streams.
Correct.
Basically, or higher revenue.
Yeah, it gives you some flexibility,
right.
To kind of reposition your portfolio.
So, we'll kind of jump back. You had written a really interesting article on LinkedIn, right? Mm-hmm. And you had talked about don't get taken in by the real estate hustle, mm-hmm. right? And there's a lot of it. I mean, you go on Instagram or TikTok or YouTube or anything like that. And obviously being in real estate, my feed is going to be fed real estate.
I get specific, it too.
Right? You do too. Okay. Why don't we talk about that? Not being drawn in by the real estate hustle, because we're very protective of our clients, as you know. And you see people making decisions and it boggles the mind. So why don't you address that and talk about that?
Another thing that I said in that article is, real estate is a career, not an asset class. And of course it is an asset class too, but I'm trying to distinguish, I mentioned sweat equity before when we were talking about these other properties in Princeton that are for rent. The guy mowing his lawn, dealing with the tenants, right? The concept of passive income, that's a pet peeve of mine. Passive income is
it's not passive if you're mowing the lawn every Saturday.
Exactly. Right? And it's not passive if you are actively putting in a lot of work to select the investment, to do all this, to monitor your investment through time, right? And so in some sense of the word, there's really no such thing as passive income, right? Any income is passive, but I mean, we know what it means. It's when you have enough wealth where the income from your stored wealth pays for your lifestyle, right? That is passive income. But if you are using your time to get that passive income stream going and investing in a bunch of real estate properties to get there, that's fine. That's been lucrative for a lot of people. But I think the way that that's presented in social media, it exaggerates the benefits and it downplays the risks.
I think it downplays the time.
And it downplays the time that it takes to do that,
Yeah.
right? Everyone's like, I think I wrote, the touchy-feely real estate mogul. I have another article. So right now you're talking about the Let's Get Real About Real Estate article.
Let's Get Real About Real Estate, which is a great article.
Yeah, thank you. There was like kind of 7 points of observations I've made in working with clients about the, intersection of real estate and their wealth. It goes through just, everything as simple as like buying your first home to upgrading from a starter home to downsizing as an empty nester. We talk about vacation homes. We talk about rental investment properties, which is kind of getting the lion's share of what we're talking about today. I think, that's the point, right? It's just that it takes effort, and you should be considering that your vocation as a real estate professional if that is what you're doing. And like I said, there is risk. I've seen firsthand the downsides of, putting all your eggs in the real estate basket. And I think there's a recency bias, right? In behavioral economics, there's these behavioral biases that people exhibit with how they make investment decisions, right? And recency bias, I think, is very poignant right now in real estate, where people are looking at recent returns of real estate and saying, how can I go wrong? And, I remember very clearly the last time that went really badly, in the lead up to the great financial crisis of 2008, 2009. Coincidentally, I was at Princeton at that time. And, my father was in real estate, and that was a really tough time to be over concentrated as a family in that asset class. So I'm not saying that that's going to happen, that's around the corner. By all means, no, I don't think now rhymes with 2007 hardly at all.
Good.
But I think that, look, if we have one gospel to preach at Target Rock, it's diversification. We still have what we like and what we don't like, of course, but we also have to have the humility to know that we don't really know what's going to happen, in the world, in financial markets, stock markets, bond markets, real estate markets. It's really hard to predict. That doesn't mean it can't be done. It doesn't mean you can't make smart investment decisions where your intuition and your research really pays off in making a smart move. But for most people, most investors, taking a little bit more of a diversified approach through the lens of, I don't really know what state of the world is going to materialize in the future, but I want to be prepared for as many states of the world as I possibly can. And that means I got to have eggs in the basket that's really good for me in this state of the world. And I got to have some eggs in the basket that's good for me in a totally different state of the world. So I just don't know which one's going to materialize. And I think the definition of wealth is the ability to maintain a high standard of living in multiple future states of the world for a long time. So that's kind of like what...
You might want to write that one down if you're listening to this podcast.
Yeah.
Give Adrian credit for it, but write it down.
Thank you. Anyway. Yeah.
So what would you say to the young investor who says, and I think this is an absolute truism, right? Look, I don't have $200,000 to invest in stock. Mm-hmm. I'm just starting out in life, but I do have 25% down, right, for an investment property, which I can buy for, and I'm making this up, $150.
Mm-hmm.
And by the way, I don't know where you're going to buy it.
Right, exactly. That's the point.
But I'm just saying,
Yeah, I think that's the point. I think for young professional, it depends. Like, what's your career, right? I think that you want to focus on, like, the best asset that you can invest in is your own human capital, right? Because that's where most of your wealth is tied up in. If you don't have a lot of financial capital, but you have the asset of time, right? You're young, you have time, you have a long horizon, means you have time to take risks and make mistakes, but also you have time to not make mistakes and start building wealth slowly but surely, and letting the magic of compounding through time kind of build wealth, right? And there's different pathways to get to the same result, and some have higher risk, some have lower risk, and some people are going to be behaviorally and personality wise predisposed to they need a high volatility, high risk, high reward kind of lifestyle, versus other people who are, more consistently kind of chip away at a goal. So, I mean, to your point about like, okay, I have $25,000 down, or I have 25% down that I could use. Like, should I buy an investment property with it? I think the two things you got to be careful of are you going to select the right property? And are you going to have the tools and the time to do that properly and make a really good decision? Because, buying one property is very undiversified, right? You could go and you could put that 25% down payment in a diversified basket of stocks that tracks, call it the S&P 500, right? There's a lot of ETFs out there that you could just buy. I could buy 500, 1,500, 3,000 companies, shares of different companies operating around the country, around the world, in all different industries, all different sectors. To me, that is the first thing that you should be doing with your money, before you think about kind of diverting your time and attention away from whatever your job is to earn that money in the first place and enhancing your career in whatever your industry is, right? Rather than kind of getting on this real estate side hustle. Again, I don't want to totally discourage it because it's for some people.
I think it's being pragmatic about it, right? Versus jumping in with your eyes closed.
Right. So it's selecting the right property, right? And then, if selecting the right tenants, right? Because then you're going to have one tenant's income that's going to be potentially, it depends on what kind of property you buy, of course. But for, entry level investment properties, you're not going to be able to be really diversified in your tenants. And then being careful about how much time it's going to take you, right? I was kind of talking about this, right? You're probably underestimating how much time it's going to take to, actively manage a single rental property in any market.
Right. And that's the thing where I think people, get discouraged, right? Mm-hmm. And they'll buy one, maybe two, and then get overwhelmed. Their heater breaks, the tenant calls them, there's complaints, and they tap out. And in order to break through in any asset class, you have to accumulate wealth.
But again, that's a career, right?
And that's what I'm saying.
There are lots of thought leaders out there that are going to help you. If you want to be, I don't know the stats on it, but say 50 people get this grand idea that they're going to be a real estate mogul, and they're going to start small, and then, they're going to buy one, or they're going to do the play where they buy a duplex and they rent out the half. That's great. But what you're doing there is it's lifestyle checking. You're not letting lifestyle creep take over, right? What real estate is great for a lot of people is kind of forced savings, right? They're putting their money into something tangible that they can see, and it inspires them to curtail their own consumption of the asset, right? I'm going to squeeze myself into half of it, or I'm going to squeeze myself into one room and rent out the other three. That's the same principle could apply with stock investing, right? I'm going to spend, half of my income and invest the other half and instead of spending all of my income and then some, putting money on a credit card, right? So it's all the same principles of delayed gratification and letting time and compounding not get interrupted. So when you're saying people start going down this, I'm going to be a real estate mogul path, and I'm going to start small, and I'm just going to knock over these dominoes one by one until I'm, name your favorite real estate tycoon, right? Yeah, that's possible, right? This is
absolutely
go after it. But be realistic about, how hard it is to do that. It's not as easy as people make it sound. And also just be realistic about it's part of a diversified portfolio, right? And there are other places to store your wealth other than in real property.
So what would you say to the investor? So they say, okay, Adrian, we're going to take you up on this. We're going to sell our property. Of course, they're going to call me to do it, but they're going to sell their property. Now they have cash, right? Maybe they don't do the 1031 exchange, just kind of ready to tap out. But they say, you know what? I want to donate to charity, right? And I know that you're a big advocate of that. And so why don't we talk about that?
Oh, yeah. I mean, appreciated assets. And we have some, mutual interest here in promoting, charitable giving in the causes we care about. So one option is using a donor advised fund. So if you have an appreciated asset, and I wrote another article about this on LinkedIn. It's called Creating a Charitable Giving War Chest, something like that. And, a I'm really big on donor advised funds. I've opened up several for my clients who have mostly, it's all been appreciated stock so far. A lot of this is people get paid in stock by their employer and they haven't sold it. And, they've held it for a while and now it's massively appreciated. Here's the main thing. If you want to donate to charity and you have an appreciated asset that you can donate that instead of cash. Do not donate cash if you have an appreciated asset that you can donate instead. Now, it's pretty easy with a stock. It's a little more logistically challenging with real estate, but it can be done.
I have somebody doing it as we speak.
That's great.
Yeah.
So, and we're talking probably about bigger dollars, depending on what kind of property it is, but it could be big dollars with stocks as well. But the point is, that appreciation, you're talking about capital gains taxes. 501c3 organizations, as you know, are tax deductible for us. When we donate to them, they're tax deductible. I think what a lot of people don't appreciate, charities will say like, oh yeah, your donations are tax deductible. It's like, well, you really can't say that because you don't know if it's deductible for me. Because if I'm taking the standard deduction, there's no tax benefit donating to charity for me because I'm taking the standard deduction. I'm not itemizing my deductions on the tax return. But if you're a property owner in Princeton, you have a mortgage, it's very likely that you're itemizing deductions. So I think a lot of your listeners are probably itemizing, for a married couple, it's about, the standard deduction is about $27,000. So if you were state and local taxes, which thanks to the 2017 Tax Cuts and Jobs Act gets capped at $10,000. So you might be paying $20,000 in real estate taxes in Princeton, but you're only going to get credit to deduct $10,000 of that as a married couple. So that leaves about a $17,000 bucket that you have to fill, which is usually mortgage interest. So if you have a mortgage on your property, $17,000 of mortgage interest in 1 year is an itemizable deduction, right? So if you exceed that, which I think a lot of people in Princeton, if you have a kind of the typical 20% down kind of 30-year mortgage situation, you're probably itemizing. So now if you look at the rest of your wealth picture, if you have appreciated stock or appreciated investment property, donate it, put it into a donor advised fund, which you still control. It's out of your estate, but you still control it. You control when it's dispersed, but immediately you're able to sell those assets within the donor advised fund tax-free and then reinvest the proceeds into a diversified portfolio. And then you can take your time doling it out to causes you care about. So anytime I come across somebody who's passionate about some kind of charitable cause, like I know you're talking about Rescue Mission of Trenton. You have an event coming up at the Ivy?
Yep. October 4th. Yeah.
October 4th.
Yeah.
It's on my calendar.
Awesome.
I'll see you there. And the thing that I would like to plug, the kind of two things. One is Arm in Arm, which is also based in Trenton. Great organization. I was on the board there for several years. Just recently rolled off. And then the second thing is I'm an active board member on is the Friends of Herrontown Woods.
Yeah.
If you want to talk about real estate again, that is the Herrontown Woods are a gorgeous piece of real estate.
Yeah.
I was on Mayor Frieda's podcast a couple months ago talking about our work there, restoring the Veblen House, which Ingela and I took a tour of a couple years ago together. And we kind of dreamed about the possibilities of turning the old Veblen House. Oswald Veblen, Elizabeth Veblen were the couple who lived in the house. Oswald was a math professor at Princeton, donated the whole preserve to Mercer County in 1957. It was given to Princeton around 2013. And our kind of small but mighty nonprofit, the Friends of Herrontown Woods, has been working hard to kind of clear out trails and host all kinds of really fun events at the woods. So the intersection of charitable giving and wealth management and real estate, come talk to us about your wealth picture and how we can kind of put the pieces together to make a big impact on charities as tax efficiently as possible.
Awesome. So thank you for coming today. How do people find you? What's the easiest way to track you down?
I think just LinkedIn. Just find me, Adrian Colarusso, on LinkedIn.
And I'll post it. I'll absolutely share it.
Yeah, thanks.
Yeah.
I mean, I put, my partner Matt and I put a lot of stuff on there. We have our biweekly newsletter about all things wealth management. And yeah, we hope to see some of you on there.
Awesome. Thank you for coming in today. Thank you for being the first guest on the Wilton Report.
Thank you so much, Josh.
So that's it. That's a wrap for the 36th episode of the Wilton Report. Thank you to Adrian for being our first guest, and we'll see you guys all soon. Thanks, everybody.